Good afternoon, everyone. Welcome to our session on outcome-aligned student finance. We are going to have an exciting session, pretty confident this afternoon. I'm Sacha Litman. I'm a partner at BCG's Education and Employment Practice, and I've been fortunate enough, both inside of BCG and outside, to have a chance to work around outcome-aligned student financing. And really what prompted this session in many ways was with, a number of the regulatory headwinds that some outcome-aligned student financing that we'll talk about today have run into, what does the future for this space look like? And so today, kind of the thesis and just my view of having watched this for a while is that by and large, one of the challenges that our field has is that we tend to look for silver bullet solutions. I think in many ways that can be pointed to as one of the challenges with income sharing agreements, which we'll talk about in a second. One of the challenges I think is for higher ed institutions or alternative education institutions being really clear in terms of what is the strategic goal they're trying to achieve through this type of student financing. I think that's a longer conversation than a lot of institutions give credit for. And also defining who are the student target segments that are desired for the program to appeal to. And I think for that, there's a lot of research and a lot of test and learn pilots that need to be that need to be explored in order to really figure out what works. Because the truth is, this is a very nascent space, and we don't know the answers yet. There's some interesting papers out there, some interesting research, but we don't really know the answers. And then, of course, there are the questions I think a lot of us have grappled with, which is, what are the sources of capital? And what are the projections in terms of who's on the hook for what? And then finally, and I think our panel will follow this arc, is when it comes to implementation, how do you have a really good implementation plan around this? Because there is a lot of institutional risk if these things go awry. And finally, how do you ensure that you don't get dissuaded by, or your customers don't get dissuaded by the potential complexity of some of these instruments, and simplicity being really core to gaining market share in any new venture or any new space. So to that end, I am fortunate enough to be joined by three terrific colleagues in this area. Ruth Watkins, the president of Strada Education Network. Ruth also formerly president of University of Utah, where she did set up an income sharing agreement, and we'll talk about that later. Tess, who is the CEO at Stride Funding and has been in this space for a long while and will share her perspectives. And then Aanand, Radia, Managing Director at Achieve Partners, who has also been around this for a number of years and from different perspectives. So I think I'm really looking forward to today's panel, and I hope you'll join me in welcoming our panelists. So let's start with the question that I sort of foreshadowed there in the introduction. We know the regulatory headwinds. Many of us are aware of the regulatory headwinds that income sharing agreements have run into lately. What are your thoughts on basically what are our learnings from the last couple of years around income sharing agreements? And I think you've all experienced those, so I'm going to suggest we'll start with Ruth, and then we'll go on down the line here.
Okay. So probably good to give you just a little context. I've been in higher education for all my adult life, and maybe even before I was really an adult, as a student myself. Traditional higher education. Then in the last 20 years in a variety of leadership roles, academic leadership roles. Vice provost, then a dean of arts and sciences, a provost, and a president. What on earth was I thinking when I thought we should try an income share agreement and an income share program at the University of Utah? Context. University of Utah, really different student body with different needs and different approaches than the student body I worked with at the University of Illinois in Urbana-Champaign. Much more likely to marry as undergraduates, to have one or more children, very debt averse. And the Illinois way, $1 borrowed is $1 earned in the state of Illinois. And that sort of permeates a lot of things about the way the institution works. Utah, incredibly different culture. So what you get at the University of Utah is students that are within a year of finishing, and they take 3 to finish. They go to school a year, they work a year, they go to school a year, they work a year. Incredibly responsible, remarkable people, very goal-oriented and education first, but also managing complex lives. So as I looked at where we were as an institution, with a flagship research university with a high-performing research, within a graduation rate in the 50% range, 50 to 55%, not acceptable. Too many people taking too long, a lot of opportunity cost. So I'm looking at the tools in my toolkit. Of course, philanthropy is an enormous tool. Strategic philanthropy from private donors makes a big difference. We needed more tools to help people. With a debt-averse population, the idea being if the institution could set up an income share program for people near the completion finish line, within a year is where we first started of finishing, within 2 years is where we ultimately ended up of finishing. The most student-friendly terms designed to help those people that are close to finishing do it in a more timely manner. Finish in 1 instead of 3. Completely with one goal in mind, raise completion rates, get more people to completion in a timely manner. Not an institutional financial effort in any way other than to try to help students. So what did we learn from this effort? We had the outside advice and help of a group to give us some guidance on setting up the model, but otherwise we ran this inside the institution. Donors helped, so donors joined us to help bring the cost down. The terms are remarkably friendly, and it was difficult to get students to sign up. So, which I found very hard to believe. This program's called Invest in You. You could probably still look it up on our website. Really a good title. Wasn't that a great title? I mean, Invest in You. How could you go wrong? And so much going for it, and so friendly in terms of its terms to students, but hard to explain and hard for people to understand the terms. Also hard, talk about the institutional change journey. Anybody here ever tried to influence financial aid at a major university? Not the most customer-friendly group. Sorry for anybody who's here in financial aid. I just thought of that. Maybe it wasn't my best play, just in case there's some financial aid folks here. I think it's the compliance and the regulatory environment that makes that group pretty resistant to new ideas. So we had our own institution to drive. We had students to convince. And then we had some headwinds. Nobody really likes to have an article written about you that says, this is like a predatory thing that the university is trying to do, which could not have been more far away from the truth. Yeah. But all those things, some insights.
Thank you, Ruth. And one of the beauties of this panel is we're going to hear the perspective. Ruth is former university president and funder. Aanand is an investor in the space, and Tess as an entrepreneur in the space. Aanand, let's go to you on a jump here because
sure,
you've invested in a number of these. What are your lessons learned from ISAs?
Yeah, so just again, for broader context, so Achieve Partners, our predecessor entity was University Ventures. At University Ventures, we focused on investing in both the boot camps or sort of last mile training programs that utilize these as a form of tuition payment, right? The income share agreements, as well as a bunch of alternative finance companies, including an ISA structure and servicer, as well as some alternative lenders that are utilizing outcomes metrics for making decisions around financing, which is makes sense for thin credit files, et cetera, that younger borrowers have. What was really interesting to me is having had a background in fintech before coming into education. 10 plus years ago, it seemed like such an elegant solution, which was basically a loan with an insurance wrapper. And it seemed like, okay, well, whatever the loan price is, the insurance wrapper will have some incremental cost associated with it, right? It's lowering the risk to the student, but that comes with a higher cost. What I didn't anticipate was, because you're paying the premium, effectively the insurance premium after, you have the incident, which is you either if you're someone who had an adverse outcome and you didn't have to pay anything, you're not going to be shouting from the rooftops, this was the best thing ever. It was just, hey, I probably shouldn't have even gone to that school or done that thing. And if you're somebody who had a good outcome, well, then you're subsidizing, all the people who didn't have as good of an outcome. And there's sort of this, buyer's remorse there. And so if you look at the cost just of a traditional private student loan and you tack on some, additional percentage points for insurance cost, and you start to, and you've got a bunch of other people who are also in that equation, who believe that education should, this is, completely valid thought, but who have the belief that education should be free, and there should be, no sort of free market enterprise place in that. That's an easy place for them to go and extrapolate out what is the total cost of education when you add up, X number of percent over 30 years. It's the same thing when you have a home mortgage, right? I mean, if it's 30 years and even if you have a low rate, when you look at the total amount that you pay over those 30 years versus the principal amount of the mortgage, it's like kind of an eye-popping amount for someone who's not super comfortable with the compounding math. And all of those forces converged with ISAs, where it became sort of an easy political football, even though it was a relatively friendly product. And so there was this combination of things that I think occurred, and they all occurred at a time when the industry was sort of small enough to crush it, right? I mean, you see the same thing happen in other things that get regulated, whether it's cryptocurrencies or pay-to loans or whatever, but those are large enough to push back,
Right.
Where ISAs were not.
Right. So Tess, we've just heard two fairly bearish perspectives. Do you have a more bullish perspective around what we've learned from ISAs?
Yeah, no. So I think, stepping back at the end of the day, I think the narrative's not necessarily just around income share agreements. It's about outcomes-based funding more broadly. And, I founded Stride very much from a student-first perspective. So sitting in that seat and realizing that, students have to take a massive risk, which is a bet on themselves. And, there's no guarantee waiting on the other end that there's going to be a great job or that this program's going to give you the support you need. And so the spirit of these types of products was to really demonstrate that we can align that cost of your education with the value that you're getting. I think, in the early days when you tried to create a new product or a new asset class, there were a few issues that first came in. One was, how do they make the capital affordable? Like Aanand said, they struggled to make the product similar cost as a traditional private loan, so students were choosing between flexibility in the structure versus affordability of the product itself. And I think that has meaningfully changed. I know we shared yesterday that we raised another $105 million to fund outcomes-based funding products at really, really low costs of capital. With traditional investors coming in, it means folks are seeing this become more mainstream as more data comes in and as providers think about how to drive better performance. Second was really around how do we think about who's actually managing these programs. Early on, as Ruth mentioned, schools tried to bear the burden in a lot of ways, and educational providers are not financial providers, and you need to make sure that the systems are in place to originate and service and add wraparound support and actually make sure that we are supporting students during school through retention and then on the back end through placement. And that's just a critical component. And the last was flexibility around what the product itself needed to look like. Again, the income protection was the spirit of the product. It doesn't mean that the repayment needs to be a percentage of income thereafter. So, we have multiple products in our portfolio. One of them is a retail installment contract. You pay fixed dollar amounts after you're above that threshold, right? And so you still get that protection, but then the payments are really easy to explain and, very streamlined. And so in a lot of ways, I think the space itself has evolved, and the regulatory environment, if anything, is just trying to add clarity and safeguards into how we actually help this space grow. And I think, that's something we can actually be appreciative of, not scared of, as long as you really put your best foot forward and remember the student is, the ultimate player that we all want to support. And I think that's something we can agree on.
Yeah, and I think to that end, it's important to remember as we sort of move from the ISA part of the conversation that there are a lot of different flavors of ISAs, right? There are those that are generating returns, right, as Purdue kind of set up, which some say was a challenge to the field. There were the Evergreen Fund structures. There's one here in San Diego Workforce Partnership that Vimo put together. There's one there are those that are schools that are just literally using it as a replacement to financial aid, where they're saying, hey, 50 cents on the dollar or 25 cents on the dollar is better than pumping more financial aid in a vicious cycle. So I think some of the subtlety got lost in the shuffle as well. But Tess, you start to mention some of the other products. Let's talk about let's broaden the aperture here and talk about the landscape of what's available today. There are a lot of different outcome-aligned student vehicles that are student financing vehicles that sort of get at the spirit of how do you create the protection for the student. Let's talk about those that you're looking at in your respective portfolios. Tess, do you want to start with what you have?
Yeah. So again, when we think about the broader portfolio, we started with, initially I was inspired by income share agreements because it was so innovative. It's the farthest along on the spectrum as we think about innovation. Private loans over here, income share agreements here. And we've kind of worked our way actually more down to the middle. So our second product, which is actually our largest, is a retail installment contract. You call it a deferred tuition agreement, but it's a retail installment contract that, again, has that income trigger built in. And now the team is launching with a chartered bank partnership to look at more income contingent loans, so more traditional loan-like products, but again, that have income-based protections built in. And as we think about the space evolving, I think that's a really nice piece as you look at different menu options, and different schools have different needs and different students have different appetites as they think about the structures that just fit them best based on their personal situation. And that's really how we think about the evolution.
Aanand, how have you evolved your thinking around this space and what could and should be offered?
Yeah, so I think ultimately there will be a lot of different products across this space. I think there will be outcome-based loans. I think there will be different forms and flavors. You're seeing some people make innovations around the loan insurance component, which can be parent-sponsored, school-sponsored, which is also I think fairly interesting, right? Because ultimately what you are talking about with an ISA is it's just a loan with this income trigger and then an insurance wrapper built around it, and so people are sort of selling those products separately effectively, and so I think that that all comes down to execution, and so it seems like Tess is making a lot of headway there. Where we've come out is actually the ultimate sort of end beneficiary of all these things are the employers, and so largely what we've done is actually we've gone out and sought to purchase businesses that exist in skills gap areas like cybersecurity services, for example. And we deliver bootcamp programs not just for free, but we actually pay the students while they're in them. In exchange, what we're doing is we're assuming that we're going to be able to bill those students out at a significant markup over the next several years delivering services. And that's either in sort of a consulting or managed services or staffing-oriented fashion. So that was, we first iterated on that with Reviture, and now we've done it many times over now in lots of different sort of sub-niches throughout the technology and healthcare spaces. And so that's, effectively, in many ways, the same thing. We're just wrapping up the financing and the instruction delivery, into an existing company that we, middle market business that we go and buy that exists in a skills gap area. So it's just sort of a different flavor of kind of the same thing.
Yep, makes sense. And Ruth, you've had the benefit of moving from the university side where you're trying to solve for the specific needs, now more broadly solving the needs of a field. What are you looking at now in Strata in terms of different vehicles that you find compelling?
So I think there's probably never been a moment better than employer efforts and partnerships. And the employers are so desperate for talent with the skills and the abilities that they need, that this is a moment to lean into innovative approaches around industry and employers, helping with assisting tuition costs and helping individuals make their way. So I think Strata will do a lot of that. We did that in Utah in a particular area of need through a forgivable loan mechanism and also paired with philanthropy. So the trick of some private dollars to help you make something happen is enormous for student affordability, and there's really no other way around that. For anybody who's leading or running an institution, you're always going to try to do what you can there. I think from the seat we're in at Strata, the opportunity to help employers see how they can be part of the solution. A very large financial employer in Salt Lake told me it costs us, this was several years ago, $5,000 to recruit an entry-level position. Of course, my immediate thought is, how about you help the student finish with that $5,000 and you have a relationship with them that helps you build towards recruitment of that individual. So I think there's a lot of creative efforts happening there, and I hope we see more.
Yeah, and to that point, this is, I think there are a few panels that BCG has been facilitating today, sort of partly around this sort of question of, we talk a lot about this at this conference about education to employment, right? But how do you actually build those partnerships? How do you finance those partnerships? This panel, how do you gain the analytical insights about what skills gaps need to be addressed, which is another one. So I think these all have to be talked about in concert. This is a systemic issue that we're trying to solve here as a field. But we've talked about the landscape of different types, LRAPs, loan insurance products, basically. Employer loan repayment, employer, payment up front, where the student sort of commits before they start school. Talked about sort of the last mile funding. There's some schools, you guys didn't address this one, but there's some schools that have set up, instead of actually a financial vehicle, they've said, look, when you finish school, if you don't have a job that pays X, you can come back and take grad school courses or undergrad courses in another major for free, right? Until you basically have the skills you need to get a job. That's our guarantee to you. Now, there's a bevy of others that we haven't talked about here, but what's your favorite right now? Like if you had to pick one, what are you betting on?
So my point of view as somebody who's to some extent, been, touched all these different solutions in some way or another, either as a consumer, when we own a boot camp, or, whether it's through the provider side on the, investing in the, fintech companies that are helping deliver this, or, what we do now, which is, owning majority share in companies that are effectively sponsoring these and delivering training. I think it's actually going to be, there's no like one size fits all, right? I mean, as we kind of talked about, everyone's looking for the silver bullet, and there is no silver bullet. Our solution works very specifically in industries and spaces where employers can make it work financially to deliver, to pay someone a salary, to train them without getting any revenue off of them for 4+ months, right? And not 100% pass-through rate. On that, to ultimately, getting to success and getting billing and all that. And so that's only going to work for one, specific type of role and job. And so you're really going to need lots of different solutions out there, and each one of the different stakeholders, whether they're universities or boot camps or even where they sit in that university spectrum, because obviously not a monolith, they're all going to have to find what tool they need. Right. To ultimately accomplish their goal.
It's a great point. Maybe we should just reframe the question as, where are you seeing the fastest student uptake, right? Because to the point we were discussing earlier, since we don't know what's going to work for different segments, among the things that you've seen, where are you seeing the uptake right now?
Yeah, so I would say, coming off of Aanand's comment around, there are just different educational providers, and I think where we see uptake from students just differs based on the institution. So when we look at, for example, non-degree programs like boot camp programs, certificate programs, the victory is not getting some fancy diploma or walking across a graduation stage, right? It's getting placed into a great job. And so outcomes-based products are fundamentally really critical for students making that leap of faith to join these programs, and there isn't federal funding available, right? So in those cases, you typically see it as a way to drive enrollment, and I think it's actually incumbent on providers of financial products like ourselves to be really selective on which schools we work with, because we want to make sure when outcomes-based products are offered, it signals quality, right? And students can take that bet knowing that it's available for a reason. And with that being said, I think employer pathways to funding or sponsoring education is something that we've seen a lot of recent growth and uptake, and it makes the equation really a win-win-win, right? You have the employer sponsoring the education on the back end and guaranteeing a job. You have the students' risk mitigated, and hopefully retention in the job actually increase. But that is one where there's very specific programs where employers at steady state are willing to fund, and where there's enough students at scale.
That's great.
And I just want to say, this is what has to happen. I mean, if you think about what are the barriers for individuals that need this kind of short-term credential to job, the financial barriers are the number one issue. Financial, sometimes childcare, sometimes transportation, family, time, right? So the solution on finances, which is also embedded education, as in you're learning while you are working here, are the best possible solutions.
So I want to come back to that point, because I want to pivot a little bit away from the products now to the adoption of these by the institution and what it takes to build in terms of capability at the institutional level to deploy these, whether it's with an outside partner, yourself, whatever that construction looks like. Because one of the things I would point to is that, yes, financing is an issue for higher ed, but if that were the case, everyone would be going to community college because it's basically free, and they're not finishing, right? So the return on investment is obviously an important piece of this. So to that end, what are the capabilities that a university needs to have, or institution of alternative alternative student training program needs to have in order to be able to do this and stand something like this up.
So I'm going to try to figure out who you are, right, to see how provocative this is all going to be. Does anyone in here work in a 2 or 4 year institution? Oh, good. There's a few fellow travelers. Not many, though. There were 4, I think, hands. How about individuals in the kind of looking for great business opportunity, investor, early stage company, those kind of things? A few. Not very many. So who's everybody else? Who are you people, right? Okay, alternative pathways. So, for example? Okay. So you're interested in how do we help more people into and through our boot camp with a new financial tool. Okay, good.
Community college board member.
Oh, very good. All right, excellent. Anybody else that's not represented? So you're here because you wanted to come to say, what are some alternative financial tools that could help me succeed with my students and my programs? There's a few people that have a company and an idea and investment. And there's a few people leading in more traditional institutions. Okay, so I'm going to just say my bias will always be that if an institution of whatever type can do it themselves, they should. Because otherwise, they're just another group of people that are trying to make money on the student. Now, that's probably like a horrible thing to say at ASU+GSV. But it's kind of as a frugal institution leader, you're trying to think of how do I help these people the most with what they came for and not have to tack on extra cost. Now, what are the caveats to that? Universities often don't have the expertise to do these things very well. And I'm guessing community colleges probably don't either, right? What is that expertise? It's really capacity in a broad sense. Do I have the capital? Do I have the resources? And if investing in this particular effort means I can't do something else, what's the consequence of that? So there's the capital. There's probably, maybe even more importantly, the expertise. Do we have enough knowledge to do this well, right? And then maybe there's a third kind of broad area that is, do we know enough about compliance to not get ourselves in a lot of trouble by trying a creative thing? So I think there's a filter that you have to go through when you're leading an institution to say, if we could do this ourselves, we should. But a lot of times we're going to need some advice and help from someone else. But I would never I would always start with saying what's possible here because it will keep the costs lower.
Tess, how about from your perspective? When should someone partner with you? When should they do it themselves?
I mean, a lot of respect for institutions that early on in the space tried to do it themselves, but I actually think that was a big reason for a number of the early failings of the space because there's just a lot of complexity for outcomes-based products that go underappreciated. For example, a big part of the initiatives are the program design and the underwriting of actually figuring out which students get access, making sure they can actually manage this debt, looking at what are the other costs they have, what is that program's expected outcomes look like, and how do we look at also their general credit to make sure that this is someone who's really going to be able to afford these payments on the back end. In addition to that, making sure you structure these programs in a student-centric way, right? At the end of the day, you have to think about, what does the duration look like? What does that income threshold look like? And how many standard deviations is it from, the average earnings that we're looking at from this institution, from this program? How do we think about the cap and making sure that even the payer who's paying the most is still paying an affordable amount? And then beyond that, on the compliance piece, I think, a number of programs that we ended up taking over, schools tried starting it initially themselves, and the way the contracts were structured and the way that the servicing was handled was not done in a compliant manner, and it honestly was part of why there was so much regulatory scrutiny to begin off with in this industry and why initially we had to try and really clean up how folks viewed the space. It was never meant to be predatory. Early on, again, the capital was expensive. I think that's something we've seen a big shift in the market. But at the end of the day, educational providers are different than financial providers, and they should be there to support each other and make sure that the educational providers are focused on outcomes. How do we keep persistence in programs strong? How do we help with, placement post-program? And the financial providers should focus on how do we structure these products affordably and how do we make sure that at the end of the day, the school's job is not any harder because they offer a product like this.
Now, obviously, for any institution to pull this off, whether they are Title IV or non-Title IV, there's always the question of financing, right? Where do you get it from? There are a lot of sources, right? You could get it from, employers' balance sheets. You could do it off of schools' own balance sheets, sometimes not possible for a startup institution. You could do it from private funders. You could do it from private philanthropy and donors. States are even getting into this game now. Let's talk about capital and what makes sense when. Aanand, you're on the funder side. What makes sense when?
Yeah. So, it's interesting, effectively on the bootcamp side, anytime there's an ISA being done, usually what you see are very low, what we call advance rates, right? Which is if the tuition is, $10,000 and a student gets an outcome-based loan, the school might be receiving, $8,000 of those dollars up front or over the course of that student's 3-month journey. With an ISA, it might be $5,000 or $4,000. When you think about that, depending on what the cost structure of the school looks like, effectively that's being financed by the equity holders of the company, right? Because that just requires more equity capital because you have to deliver these services without getting the upfront cash. But for equity owners, that can make a lot of sense if you want to get a business to scale, particularly given them how the cost models work. What's interesting to me about what's happened in sort of ISA land is that ultimately for something like an ISA to really work at scale, you are going to need private capital sources that can get a market return for that level of risk that they're taking. And, even what we saw a year and 2 years ago, and, I don't know what's happening more recently, but, you were seeing sort of states, right? So in terms of what Purdue is doing, which was layering in pretty low levels of capital because they were Purdue, right? They were one of the most prominent universities in their state, and they can go and access capital at a relatively low rate and ultimately net yields that were not market rates, but were still far too expensive, to avoid any headline, right? And so I just, ultimately for this to work, I believe you're going to need a lot of philanthropic capital effectively. You're going to need a lot of either endowment capital that gets pulled into this or other sort of, ESG capital that acts as, like a first loss layer or something like that. To make this work. And I do think that there's a place for that. Right now, this idea that instead of just donating to a school once, right now you could donate into a program that maybe doesn't have any return of, it can be a 1% return or something, and it just is an evergreen fund. And, that is more sustainable. So I think ultimately, based on what I've seen, the models that will ultimately work here will be when you can get lots of cheap capital to help subsidize these programs to make them more evergreen. So why give a student a full scholarship when you could give that same student, an income share agreement that requires, if they become a billionaire, they should pay something back, right? It shouldn't be a portion of their $1 billion, but it should be something. And so, and I know that's very ironically, Liz Warren-esque in this time, right, who's come after ISAs. But, I think that's ultimately what's going to make this very successful, which is having these dollars that would normally go into the endowments of a school going to be subsidizing these programs blended with private market capital and increasing, access to friendly financing.
Yeah, you're reminding me of the Australian model where it's somewhat pivoted off of tax collections after the fact in terms of your earnings, which is basically an income sharing, but just a government-funded version of it. Ruth, what about from where you sit? You agree with Aanand on this in terms of where it gets used?
I do. I think what made this work at the University of Utah to create it, and it all ultimately succeeded, it just took a long time, was having the donor philanthropy to help us reduce the cost. They were attracted to an evergreen fund. They wanted to contribute, and they liked the idea that the students they helped were in turn going to help the people behind them, and turn the people behind them. So I think trying to design with some of those principles really will help make this both affordable and manageable and stay out of some regulatory efforts. I would also say don't forget the employer side. In our case, it was health-related industry. This is a national challenge, right? In physicians in this particular case. With a competitor, the university's #1 sort of competitor in healthcare providing wanted to help fund additional physicians and created a mechanism with us to do that. But it also had a philanthropic layer at its foundation, again, making the whole thing work. So I think it's kind of hard to escape that as what will make this function.
Great. Well, we have 5 minutes left, and so I kind of wanted to move to our last question. It's been sprinkled throughout the panel, this conversation about if, we've talked about the future being around employer-driven structures, right? Job guarantees or, offset to loans or other types of structuring, a lot more partnership with the educational institution. But towards the theme of simplicity, which we talked about, the sort of the hobgoblin of this field is you're introducing a new category, people don't know what it's about, they get confused. If we're to sort of put ourselves in the, as Ruth likes to say, the future-facing mind of like 4 or 5 years from now, right? How might the employer-driven model, to focus on one for a second, really make this really simple? Like, what is your pitch in terms of how this really gets to students and people are just knocking down the doors?
Yeah, I mean, so we focus on obviously an employer-driven model effectively, but we've largely sort of vertically integrated a lot of the financing, the placement. We built our own sort of training capabilities, utilizing the company's subject matter expertise in whatever area they're in. Our hope is that, and we're seeing it, right? So we're seeing this dynamic where that offering in the space creates something really unique, and then competitors try to copy you. And the positive benefit of that is you have lots of people now offering, hey, like we get like 100 applications for every spot that we fill, because again, these are not, you don't need to take time without a paycheck. We're offering you a job plus training that at a level just isn't really offered anywhere else. And the more competitors there are, the more that will push, anyone who's not doing that, they'll be at a disadvantage, right? And so our belief is that the way that you sort of push this employer pay model is by making a talent supply chain and talent investment a competitive advantage to which other participants in the market have to react. Again, I don't believe that this is applicable everywhere, but that's sort of one thing that we believe we can affect in a way that makes sense to us.
Now, Tess, you've came up through this as a student, an interested student. If you are to give your version of this as an elevator pitch to a student, to this employer-driven model, what does that elevator pitch sound like?
Yeah, actually a number of our partners have already started launching employer-based models, and it's pretty interesting to just see the difference of adoption there. I would say, one is first just understanding why they're scared to pursue this education, and oftentimes it's really expensive, and how do I know it's going to be worth it, right? And those are the two things. Can I make time for this, and can I afford it? And so saying, look, at the end of the day, we're going to make sure that you're guaranteed there's a job waiting for you on the other end. You're going to get to know this employer while you're in school. So actually build that relationship, get up the learning curve, culturally be integrated. And then as long as you join that employer and stay for X amount of time, your tuition's going to be paid off, right? And I think that's a really, special way to connect the ecosystem that candidly existed years and years ago and then took a pause as a model in recent times and is now coming back into the fold. And it's something that we're really excited to see happen both in the non-degree space and then within certain fields like healthcare and the degree space. And so definitely a great signal.
I think for this to work at scale with the employer side, there probably is going to be a need for some kind of an intermediary. Because I think about even in the little example that we did in health, there's the employer that's helping philanthropically, creating the forgivable loan, does not want to have to be in the business of follow-up management, tracking. So it's a little bit different kind of capacity and role than maybe, but what is it going to take for outcome-aligned student financing to really work with the industry partner? Somebody's going to have to step into the space and be that intermediary, particularly in the areas where there's not a well-developed university system to support it. I'm guessing there's less capacity there. So that would be sort of a call to the future. If we want this to work at scale, somebody's going to need to step in and facilitate that.
Yeah. And one thing just from my own observations I would add is, if we want to talk about simplicity, I think one thing that I've seen with a lot of students is they want to maintain their optionality. So you have to also beware a system where basically students feel everything's so vertically integrated that they are now having to commit to an employer before they even start their education. That sort of undermines the very thesis and foundation of education, which is to have options. So, I think we have to think about how do you build in the optionality for them as well. So, that's why I think sort of, repayable loans, which is a model that, a lot of firms have used to reskill, send students who have a BA back for an MBA, and banks and consulting firms have used that for years. Might be an interesting model to use as well. We are out of time, but I want to do two things. First, in the back, if you're interested, there's an article, a white paper, as part of evolution of some of the thinking on this that you can grab. We don't actually have the paper. We got techie this year, and we have a QR code that you can either scan directly on your phone or just take one sheet. That way we didn't have to print out all the pages. And I want to invite you to just thank all of our phenomenal panel participants.